podcast. Joined as always, he doesn't want to introduce himself. I'm going to introduce him today. The handsome Chris Berg, former Stanford Cardinal quarterback, current acquisitions lead for Abernathy Holdings, host of the CRE report. Incredible list of guests that he has on there. You guys will see through the course of the report today links to his podcast that you can sign up for so you can see the guests he brings on as well as mine. We want to jump in today. We've spent the last couple of weeks talking about a couple pretty cool things that we're starting to get more data on as far as the housing market. You know, obviously movement is a big impact in the self-storage space. And then also the turnaround, increase in Google searches we talked about last week, and whether associated directly or not, the first time in a long time that we've seen street rates and web rates take an uptick was reported in May. So we've got some more data that's come our way over the course of the time. Chris, really happy to dig into some of that data and really talk with you about what you're seeing here and how you're interpreting this. Now, the first thing I'm going to bring up is a couple of graphs that we have where this came from SVN. SVN did a survey of a bunch of operators. And so they asked a couple questions. One was, have you seen new supply in your market in the last 12 months? Almost 30% of operators have seen new supply coming into their markets. Now, obviously, you're an acquisitions director looking at ground up development. This is something you're very familiar with. There's a lot of development that's happened in the last couple of years. Not as peak as before COVID, but definitely this is something that's a challenge in our market. The question becomes, does this amount of new supply start to have a negative impact on the rate growth that we're going to start to see? So the next graph that I was actually even more surprised by in the SVN report, in the newsletter, was occupancy trends. So you're seeing here 53% reported. This is a survey of operators, so it's not perfect data. Not necessarily every operator was touched, but a cross-section large enough to get a pretty good idea of what's going on generally. And this goes over 12 months. Now, obviously, we saw in May, there was the trend of an uptick May to May, right? Year over year. But over the course of the last 12 months, occupancy has been actually stable or trending down in almost 90% of operators' facilities. So a couple of data points that I ran across this week, maybe counter to what we've seen for more recent data trends as far as the increase in Google search and the increase in rate, makes it very interesting. And I'm going to ask your thoughts, Chris. For me, very interested to see what we see for data coming out of June.
Definitely agree with you on the June aspect and the data points there. I think one important note, at least based on what I read from this data, is that it was more interviews that she's done with like operators that she works with and knows. Yeah. So I think it's important to compartmentalize like the data you're seeing here is, hey, these are personal interviews, conversations she's having with people, which is great. I think that's great to share that information. And, you know, if you get into the financials of the REITs who are managing thousands and thousands of sites, I just think, in my opinion, it's a much better data pool to pull from. And so when you see some of the REITs talking about, hey, occupancy's been up, you know, year over year, rates have been up year over year, we're starting to see some things trending in the right direction. And then you lay the Google search data that we talked about last week on top of that, as you just mentioned. I think the June data point is going to be fascinating. I think that's going to be a higher high from what we've seen, not from the COVID years, but from some of the previous years. I think it's going to hopefully set kind of a new floor, because then, as we know, it's going to go all the way back down until January. But hopefully there's a new floor there that's a higher low. I sound like I'm talking about stocks, but it's kind of how it's playing out, right? Yeah. A higher low, and now we can start to go back in another positive direction.
Definitely looking forward to seeing that. Listen, I shared a couple of data points that I saw that I thought were interesting and counterpoint to this kind of positive news that we've been seeing. And your point is very well taken, that it is not overriding data. It's one person's experience through interviews, right? I wanted to share my screen real quick. Armand Agajanians, who most of you in the industry follow on LinkedIn, probably the most well-known presence in LinkedIn in the self-storage space. He shared this today, and I thought this was fascinating. This is a graph that's comparing the REITs street rates to achieve rates. And one of the things that's been very challenging for people like you and I, Chris, over the last couple of years is street rates across the country were not necessarily indicative of achieved rates in any way at all. And so it's very hard as a developer to go look at data that's available, whether it be Yardi or Tract IQ or Radius Plus or Store Track, and make any type of a real solid foundation about what our achieved rates might look like over time. What this is showing is that from Q4 of 2020 until now, what is being listed as street rates is starting to look much more like what the achieve rates actually are for the REITs, which I think for us in the development world is pretty good news.
I think it's great news. And I think it also speaks volumes of what you and I spoke about recently, where I think the REITs are realizing like the last place you want to be on the planet is on the lips of legislators. And so I think they're kind of going, hey, you know what? We can kind of change this business model, still keep our year-over-year revenue strong, still keep occupancy strong, and most importantly, add value to our assets, but also keep ourselves away from any sort of regs that potentially could dramatically damage the value of these portfolios.
Yeah, we've obviously covered that the last couple of weeks with what happened in California, and then a couple of bills that crossed the desk in New York City. My dear hope is that we've kind of gotten the message early enough where we avoid any large scale legislation coming out that caps rates. I'm not as nervous about transparency laws. I don't think that's going to have as big of an impact on us. On the flip side, to your point, as you've always said, that's a slippery slope to go down once you start having legislation start to curtail your asset class. I want to stay out of that. Something that you've been talking about, we discussed the housing market and what's going on. And so I wanted to call up a couple of things that you shared with me this week about Lennar and what's going on with the home builders. So I'm going to share this graph of Lennar's average selling price net of incentives, right? So if they're giving a discount for different things, this is inclusive of that discount, right? Taking that off the total price. A little bit of and this is one of those things for me that is, it could be good news for storage. It could not be so good news for storage, sort of depending how you look at it. I want you to tell me your interpretation of this.
So the way I'm interpreting this data, and I'm going to bring up another data point here in a moment, but is the fact that year over year, Lennar has now reduced the price of their homes, almost 9% since the high there in 2Q 2022. I mean, it's off almost 20%. If you listen to the earnings calls, the market is clearly softening in the housing market. I don't know if you've got the other graphic, but the incentives now that they are offering these sellers is up dramatically. So this one I think talks about their actual margins is down, but I want to do this in the context. I think one of the important conversations, if you'll allow me to share my screen, Thad.
Yeah, absolutely. Let me get rid of this.
Important things that you and I were trying to talk about recently is like, okay, so we see this increase in demand in Google search, but it doesn't really line up with what the housing market's saying. Because there's a bunch of listings, but there hasn't been a ton of transactions. And so one of the things that I think is interesting, and again, I'm so tech inept, I'm going to apologize.
You don't have to apologize to me, as it took me 20 minutes to get you the right link to join the studio. We share a little behind the scenes action.
How I'm handling this, but hopefully you can see my screen. You can see home builder sentiment, near pandemic lows. That's one thing. The data point that I really want to get at, which may begin to help explain why we're seeing the uptick in Google searches. This is from the SEP doc, Summary of Economic Projections from the Federal Reserve, which they announced yesterday we're going to keep rates flat, right? What is really interesting, and I'm going to do my best here, you can see change in real GDP. Back in March, they thought, hey, 2025, we're going to be at 1.7. They're now softening that to 1.4. So that's not good, obviously, from a growth perspective. I think from us, from a storage perspective, why we may see some more demand picking up, and you and I touched on this too recently. In March, they thought, hey, we're going to see a 4.4 unemployment rate. Now they're projecting 2025, it could tick up to about 4.5, which speaks to what we said last week. Like, hey, back in the day, you're like, hey, if I get a computer science degree, like I'm golden, right? Not so much anymore. A lot of these new graduates, I mean, you're talking about high unemployment rates in that newer grad demographic, which again, is that leading to all the demand that we're seeing in the Google search? I don't know, but I think this starts to speak to there's a lot more hesitation on hiring. You've got more unemployment, which thus has people, either moving and or living in with their parents or whatnot, and then storing more stuff. And then I think you see this PC inflation was projected in March to be about 2.7 for the year. Now they're thinking that, hey, this is going to go up possibly due to the tariffs. my point in all this is when you start to get to the rates is what's going to move the Federal Reserve, right? There are two things that they focus on is obviously inflation, but then also unemployment. So which one are they going to focus on? My gut tells me, and if you look at some of the bonds and what that market's doing, it's probably going to end up being more the unemployment that's going to move them to go, you know what? This unemployment thing is getting to be higher than we want it to be. We've got to start to lower rates, and we'll see how that plays out, which again, lower rates for developers is typically good news.
I think something we should do for next week, and I'm saying this off the cuff, is sometimes it's interesting when you go in and you look at the cost of a house at different interest rate points, right? If you look at a house at 3.5% and what your monthly payment is on let's say a $400,000 house purchase, we were below 3 at when the pandemic was going on for a while there until April of 2022. Now you're looking at 6.5, 7, depending on the day. The difference in your monthly payment on a $400,000 house is staggering. You take the highest median income of any age bracket in the country right now, I think is 45 to 55, and it's $69,000. You cannot afford a $400,000 house at a 6% interest rate with that income level. And so it'll be very interesting to see if unemployment does continue to creep back up. Does the Fed make the decision to lower prices or lower the Fed rate in order to try and create some more movement in that home market? Because quite frankly, with what's going on in the overall economy, having the housing market get slower than it's already been is not a really good sign for everything that's going on.
No, it's not. And I think, typically when you go into a recession, I think it's what makes storage an attractive asset class for a lot of people because it's obviously been very, very stable. Again, if you take out the COVID years, but it's been very stable for a prolonged period of time, which if you're an institutional buyer, that's what you're looking for is just the stable returns. But to speak to what you're saying, you start to lay on, hey, there's slower GDP growth, so that's not going to be good from a hiring perspective. But then I wanted to share this as well. My friend Darius Dale put this out where Microsoft now, laying off more people on the short-term horizon. Again, predominantly because of AI. And there's a lot of conversation going on right now where AI is going to eat up a ton of white-collar jobs. Now, how fast? I don't know. But again, it's pretty clear when you see computer science guys, recent grads not getting hired, and there's 2x unemployment in that demo versus art history degrees. Like, people need to start going, wait a second, something's shifting here, right?
I feel way better about my English and history degree from Tufts, man. I was like, I always look back and I should have got computer science. Now I'm all right. Finally, it's turning the corner, and I'm laughing. It's not good news by any stretch of the imagination, but on the flip side of it, it points to what the truth of going forward is. I guess my big question here is, do we see a confluence of events coming forward that actually hit self-storage in a way that it's never hit before, right? Because one of the big things people say about self-storage is it's recession resistant, right? 08, self-storage did great. The COVID, obviously, self-storage did really well. The challenge now is, do we see the housing market stay slow for a prolonged period of time with increased unemployment? God forbid we go into some type of a recession, as you and I have talked about with the Philip J. Anderson real estate cycle. Does it finally start to be a confluence of events where storage struggles to keep that level of occupancy and rates that they've been able to sustain over really 40 years, other than the last two being you have to factor in the incredible 61% spike during COVID. If you take that out and it just make an average from 2020 to 2025, the last 2 years were not really negative years in a 5-year scheme.
Yeah, I mean, there's so many things happening right now. It's hard to obviously say, but I think if you look at, there's obviously going to be a shrinking supply over the next 12, 24, 36 months, which bodes well for rates right in the asset class. It's so interesting because I never want to pull for unemployment. So let me be clear about that. I'm not suggesting, hey, unemployment's good for the asset class. And yet, if you look historically, unemployment's good for the asset class. So I don't want to see people unemployed. And yet as you're asking just specifically about self-storage, are there a confluence of events? Yeah, if unemployment rate starts to go up, there's going to be more movement. Like I said, either people moving back in with parents, or there's more people within a household, so I need more storage. Yeah. So it typically, historically speaking, is going to bode well for self-storage.
It's interesting, right? That point that it's not necessarily moving from a home to another home you're buying for yourself, moving out of an apartment and in with your parents is still a move as far as it goes for self-storage, right? Selling your house and moving in with your parents, selling your house and moving into an apartment to downsize your whatever you're paying every month. All of those have traditionally been drivers of people renting. You had that graph up, and I'm sorry I didn't give you a chance to look at it. I was actually interested. That was the incentives that Lennar's been offering for people
Yeah, let me share this with you. Because I
for
think,
home.
again,
I would
another
love
very
to see
interesting
it.
data point
Yep.
when you start to talk about the trends that we're seeing, whether in the housing market, the economy as a whole, 13.3%. So that this is the incentives, a percentage of revenue that Lennar is now offering to get these people to buy the homes. I think what's important for us to note is that it hasn't been this high since really, 4Q of 2009, first Q
Wow.
2010. So we all know that was
Going
the
back to the Great
GFC,
Recession.
right?
Yeah.
So point being is that are there, and I again, I think what I hear from people, and I'm still fairly new to storage, but storage can be a pretty good preemptive indicator. So when we see this uptick in demand, do I know it's due to more unemployment? I don't, but that's kind of my gut right now with the other data points that I'm seeing. And again, that does not bode well for the economy. Then you lay slower GDP growth according to the Fed, AI. Do you see this all of a sudden we go from 4 to 10? I don't think it's an overnight thing, but those guys from Perplexity and OpenAI, Sam Altman, that have talked about, hey, there's going to be a moment where you're going to kind of wake up and be like, wow, this thing just ate up a ton of jobs that I didn't even realize it was going to do.
Something that we've been talking about for a few years now is really starting to become a reality. We're starting to see it actually take hold, and it's fun every day to go on ChatGPT and have it help me with things associated with my job. The reality of having those resources, and look, I'm a capitalist at heart and I'm a libertarian, and I guess I always feel that stay ahead of the curve or you're going to get eaten by it. But for the storage report, talking about what the effects are on storage, nice to have hit that inflection point where we're starting to go up again. Reason to believe that probably is going to, I think we're both aligned on this thought, even though I may be a little bit more conservative in my feelings than you are. Think we've hit that inflection point where, we're bouncing up again in a direction that is, positive for rates, positive for returns if you're invested in the REITs. Looking like storage has hit the bottom and started to bounce back up again.
Yeah, again, I don't think you see COVID type growth in the rates, but I think it's going to be much more consistent up. And if you're going to look at it from a stock perspective, I do think this is me just being maybe somewhat hopeful, but there's going to be a new higher low in that sort of December, January timeframe, and then we can go up from there and start to see growth take place. Which again, if you are a builder right now, I think is good because supply is contracting so much over the next supposedly 36 months.
Chris, as always, love it. People that are watching, if you're watching on the recording, note our new time. We are no longer at 3:30 on Thursdays. We're going to go live every Thursday at 1 o'clock Eastern. That is 10 a.m. Pacific, which I'm throwing in there for my left coast friend. We are excited to come every week and share this stuff with you. We're talking back and forth almost on an almost daily basis about different data we're seeing and trying our best to provide a little bit of interpretation on that data. At the very least, giving you one quick place where for 20 or 30 minutes a week, you can see the data points that we've seen through the course of the week, hopefully get a little bit more education about what's going on in our asset class. You can see the link on the bottom of the screen. If you want to subscribe to Chris's CRE report, that takes you to his YouTube channel where you can subscribe to him. You'll see mine scroll across there as well. Chris is looking for land in California. So if you're somebody who has access to a parcel of land that might be right for self-storage development, feel free to reach out to him. His email is going across the bottom of the screen as well. I'm looking for land nationwide. I'm not going to embargo. What's the word I want to? I'm not going to come over and hedge in on his California land anywhere other than California. I'm looking for 4 to 10 acres. Feel free to shoot me an email and connect. As always, Chris.
Can I ask something though, man? Because you're really good at this. So I want to ask you, what was your greatest takeaway out of the data points today?
Yeah, for sure. The greatest takeaways are that Philip J. Anderson's a genius, right? For those of you who haven't read the Secret Life of Real Estate and Banking, it is an absolute must read for anyone who is either working or investing in anything to do with real estate. If you don't understand the real estate cycle, you're going to get in trouble. It can be very, very problematic for you. And so, we've talked about the secret. Like, you've had Philip J. Anderson on the CRE report, which still to this day blows my mind, because very few people that I talk to have even heard of his book, let alone interviewed him. But the point being that the signs are there that we're coming into a downturn in the economy. It's going to be very, very hard to avoid. God forbid we go to war in the Middle East to salve the economy. The only time the real estate cycle did not hold true that Philip J. Anderson speaks about is the depression in the 1930s into World War II, because so many crazy things were going on. Hopefully we don't avoid a recession by going to war. But the overall thing that I take out of this is that, we're going to struggle to avoid a downturn in the economy in the next couple of years. See it how you want. That's not necessarily a bad thing for the returns in self-storage.
Boy, I didn't think you were going to go there, but I'm glad you did. So yeah, just for people out there, according to the thesis, just be alert of what's happening kind of mid 2026. And it's going to get with AI, it's easy to get caught up on all the frothiness that's happening right now. And if this thesis bears out to be true, and like you said, hopefully there's no war, just to let people know, just be conscious of what's going on in the middle of 26 and pay attention.
100%. Chris, as always, what a pleasure hanging out for a little while and share some information. We'll be back next week live Thursday at 1:00 on LinkedIn. You can see us at the Self-Storage Report on YouTube as well. The link for that has been posted through the course of the live show. So look forward to having you guys follow. Listen, reach out to us with any data points that you folks see that you think would be important to share with people that are into self-storage and are interested in the asset class. We would love to get that information from people and love to mention it and mention you if you provide it for us, and your thoughts. We're more than happy to pass that information along. Look forward to the host of the Stories Behind the Door podcast.